Hello there everyone, today's video is all about claiming double tax relief on foreign dividends. So many thousands of people resident in the UK are now investing in the stock market overseas, whereas several decades ago it was pretty much everyone invested in the UK stock market. There wasn't much appetite or interest in investing elsewhere, but now people are investing in overseas companies a great deal more, particularly the US tech stocks. But I just want to do a video on an example of how you claim double tax relief for withholding tax on those dividends, because what tends to happen is the country from which the dividends are paid, the overseas dividends, that country will withhold some tax on those dividends. So you will get the net amount, not the gross amount, because that country's tax authorities have withheld some tax. And I'm going to tell you how you can claim some or all of that tax back on your UK tax return. So let's just take an example of Steve. Now, Steve has a salary, he's got a job, he earns 60 grand a year. What else has he got in terms of income? Well, he's got UK dividends of £3,000. So he's getting dividends from UK companies. Now, obviously, this is outside of his ISA and his pension wrapper. So I've done separate videos on that in terms of tax efficient holdings for investments. You'd always choose to put your money into ISAs and pensions over non-tax efficient wrappers. But just for this purpose of this example, this guy's got 3,000 of dividends that aren't in a pension or an ISA. And he's also got £5,000 of overseas dividends. So 3 grand of UK income on dividends, 5,000 overseas dividends. Now, the country, let's say it's Ruritania. When I was a trainee accountant, it was always Ruritania in the textbooks. That fictional country, let's assume that they withhold 20% tax on the dividend. So the gross amount is 1,000, but £200 sterling equivalent has been withheld by the Ruritanian tax authorities. So Steve's only got the sterling equivalent of £800. Okay. Next thing, double tax treaty. So we always need to consider the double tax treaty between the UK and the country that is relevant here. So what does the double tax treaty say for between UK and Ruritania? So let's say this tax treaty, which is a standard kind of model, it's based on the template set many years ago by the OECD, but every single treaty does have subtle differences. They're not all the same, even though broadly they are laid out the same. But let's say that in this particular double tax treaty with the UK and Ruritania, that the withholding tax on dividends is 15%. So there's a clause in there that basically says the Ruritanian authorities have the right to withhold tax at 15% on dividends paid to residents of overseas territories, i.e. Steve in the UK. So that's all the facts. How does that translate to the tax return? Let's have a look. So, stack all these income together, 60 grand salary, 3,000 of UK dividends, 5,000 of overseas dividends, 68 grand total income, knock off the personal allowance, 12.5 grand, left with taxable income of 55,500. How is that taxed? Well, the personal allowance, we always would generally tend to set off against the salary first, dividends treat as the top slice of income. So that's pretty much the case in 99% of the cases. So you'd set off the personal allowance against the salary first. So he's got 37.5 grand of his salary at 20%. That mops up all of the 20% band. Then he jumps into 40% band. So the remainder, 10,000 at 40%. Then you've got the dividend tax. Now for dividends, the first £2,000 are taxed at 0. And because he's a high rate taxpayer, The rest of his dividends are taxed at 33%. So his total tax bill is about 13,000. Now, yes, he's going to have some PAYE because most of his income is salary. But what about the double tax relief on the overseas dividend? Because what's happened is the UK tax authorities say, hey, look, we don't care if you received £800. That's not the figure we're going to put on your income tax return. You put the gross figure on, which is the gross figure is £5,000. So coming back here, the withholding tax is £1,000, being 20% of 5,000. I don't know. I said 800. It's £1,000 withholding on 5,000, 4,000. So he's received 4,000 from the overseas territory, suffered 1,000. But on his income tax return in the UK, puts the gross amount on £5,000, and he's hit for 33% of that. So, looking at the double tax relief mechanism, UK tax on the overseas dividend, £5,000 gross at 33%. That's the UK's rate of tax. If you're a high rate taxpayer, dividend income, 33%. £1,650 of tax just on that overseas dividend. Less double tax relief. 5,000 at 15%, which is 750. So you may say, well, hang on a minute. He's actually suffered £1,000 overseas tax. The Ruritanian authorities have withheld £1,000 on that dividend. He's only received 4,000 because they've kept 1,000. But you're saying you can only claim tax relief on the double tax credit of 750. So what about the other 250? Well, this is how the rules work. You can only claim the amount up to what it says in the double tax treaty. Because the double tax treaty says that the Ruritanians should only have withheld 15%, the UK tax authorities say that's all we're going to give you credit for. So, what's actually happened is that they've withheld too much in Ruritania. Should have been 15% per the treaty agreed with the UK, but in actual fact, for whatever reason, it was 20%. So therein lies a problem. That 5%, you will not be able to get as credit off your UK tax bill that you can with the 15%. In that instance, it's a bit of a ball ache, but you've got to go back to the Ruritanian authorities and claim it back from them. So of that 20% tax that you've suffered, the £1,000 tax that you've suffered on the Ruritanian tax, the UK tax authorities say, we'll give you 750 of that off your UK tax bill, fine. For the remaining 250, you've got to write to the tax authorities of the overseas territory and say, look, you've withheld too much, here's the evidence, here's the dividend counterfoils, all the paperwork, you've withheld the equivalent of 200, you've withheld 20% when it should have been 15. So you've withheld 1,000 when it should have been so £1,000, 20%. It should have been 15% of 5,000. So it should have been 750. So you have to claim back the extra 250 from the overseas territory. Good luck with that. That could take a while, but you know that's just the rules. So coming back to the UK tax return. The UK liability on your overseas dividend is the 33% less, which is our rate that we impose, that you would pay if it was a UK dividend, 33%, less the overseas tax suffered, up to the treaty rate, maximum 15, 900 quid. So that's the UK liability. So, like I said, the excess, that extra 5%, you got to claim it from the authorities if you can be bothered for 250 quid. Obviously, that's just a crude example. It could be way, way more than that. And then you might have your own sort of threshold of cost benefit and say, well, if it's more than £1,000, I'll get in touch. If it's a few hundred quid, I won't bother. But it's within your rights to do so if they have shortchanged you, basically by withholding too much. So The takeaway points from this are, number one, remember to claim, because thousands of people will not claim this double tax relief. So they may they get a dividend counterfoil, put on the gross amount and not know that you can claim this double tax relief. Or they'll just put the net amount on, which is wrong as well. They'll put on the £4,000 that they received rather than putting on £5,000 and then adjusting for the tax. So both are wrong. So remember that you've got to claim, but remember to put on the right amount. Second one, claim the right amount. So claiming the right amount would basically mean, okay, let's assume you've got your 5,000 gross and then you knock off the £1,000 here against the 1650 UK. Well, that's wrong, because I've said you can only claim up to the maximum of what's on the double tax treaty. So tip number 2, make sure you're claiming the right amount of the actual tax to set off. And number 3, of course, is recourse to the overseas tax authorities. So, go get in touch for the sake of a letter, even if it is a few £100s, for the sake of a letter. Get some correspondence over there to Ruritania and try and get your refund of the excess tax that they have withheld over and above what their treaty that they've signed with the UK says. So that's just an overview there on double tax relief for overseas dividends, applicable to many, many thousands of people now who will have to do this every year. And that's how you do it. But you've got to know, you've got to be armed with the facts in terms of what does the tax treaty say between the country that's paying the dividends and the UK. And the UK's signed 200 treaties almost. There's not many more countries than that in the world. So nearly every country has a tax treaty with the UK, so you have to look at that to see what is the maximum amount that the country should have been withholding. That's what goes in the tax return. Any excess you claim back from that jurisdiction, that overseas authority. So hopefully you've taken away some useful tips on what to do for claiming double tax relief. If you like this video, please do subscribe, and I will see you soon.